Assalamualaikum warahmatullahi wabarakatuh. So first of all, we're going to talk about chapter 11, cost of capital. First of all, risk and return, the correlation between creditor hierarchy and also the risk and return. You need to be understand that the correlation between risk and return is that the greater the risk, the greater the rate of return expected by investor. So what is the correlation with the creditor hierarchy? It's correlate that the lower the risk, the greater the hierarchy of creditor getting paid in case of company went into bankruptcy. So and then cost of equity, dividend growth model. So whenever we try, so there's a few methods try to find cost of equity. So first of all, dividend growth model. Under dividend growth model, there's a two method, which is historic cost and also current investment level. So if it was given, so if you were given the past dividend level for a company, so we can use the history level. However, if not, then we need to use the current investment level. However, this advantage is that we can't assume that a company will consistently pay dividend at a constant rate after a certain year, since dividend is influenced by a lot of things. It's not since dividend is not a fixed payment that is contractual obligation, so it's going to be differ a lot of time. Perhaps in this year it's going to be $5 for each share. Perhaps next year is going to be $7. So there's a possibility that it won't be consistent in the rate of payment. Okay, and then we're going to talk about the cost of equity using capital asset pricing model. So under capital asset pricing model, we're going to talk about the risk and also the premium of the investment. So first of all, we need to talk about unsystematic and also systematic risk. Unsystematic risk is a component of risk associated with investing in a particular company. It means that whenever we invest in a company, there is always a possibility that there's always a possibility that a company perhaps will go liquidity and whatnot. So that's a systematic, specific or unsystematic risk. For systematic risk is the excess of risk that was due to the market itself and was not due to the investment itself. So that's for risk. CAPM. For CAPM, the problem is that we assume that investor diversify their portfolio, which not is the case all the time. And also we need to find the beta factor, which can be hard to find sometimes for new investment. And then we need to find for cost of debt. We're going to use IRR, which means that we're going to find the interest of return from the return, and also the cost incurred for the loan note for the cost of preferential is going to be the same as. So and then after that we're going to find the cost of preference share. So for the cost of preference share, it's going to be the same as how we're going to calculate the cost of equity, which means that we're going to use the dividend growth model to calculate the cost of preference share. So finally, after finding all of the costs and the total of capital for each of the capital finance, we're going to calculate the weighted average cost of capital by using the WC formula will be provided in the exam. So there's no need for us to memorize it. So that's all for chapter 11.